U.S. President Donald Trump's Liberation Day tariffs at the start of April sent markets sharply lower, but they have been bouncing back. Still shy, though, the U.S. market of the highs reached in February. Our guest says challenges persist due to the tariffs' effect on profits and also, of course, consumer health. We're joined by Dunn, Managing Director and Co-Head of Value Equity at Morgan Stanley. Aaron, thanks very much for coming on the show.
Hi, Andy. How you doing?
It's been quite a rebound from the lows of April, but still a way to go to get up to those record highs of February.
Yeah, I think it's going to be a challenge to get there, in my opinion. I think we've had a pullback of a couple points in earnings estimates for the U.S. markets. But a lot of it's been valuation compression, and I think what we've gotten back here, and kind of regaining those March highs, is the multiple essentially has come back, and investor confidence through some of the pulling back of tariffs has actually, has improved investor sentiment at least. And a lot of what we saw in March and April was very technical in nature. So the drawdown was fears over earnings estimates, but a lot of it was technical in terms of degrossing risk, adjusting the books. But so what we've gotten back now, in my opinion, is it's been more multiple. And so, I would say from here, I'm a little more balanced on the market. I think it's going to be a challenge to regain the previous high for quite a while until we get through sort of a 90-day grace period on sort of maybe U.S.-China relations. And so, I'm a little more balanced here. I think we were more positive kind of mid-April forward because we just thought that rubber band had gotten pulled too far negative, but we've gotten that back. So, a little more cautious here.
And when we get Walmart specifically warning of rapid inflation and price increases, we know the U.S. consumer is going to be hurting.
Yes, and so, what they had to say isn't a big surprise in terms of, we've expected this sharp, abrupt increase in sort of prices mid-year. The things that we're sort of watching here from a negative perspective is, one is you've had a big swing in sort of inventories. There's a lot of pre-buying in our view that happened late in the first quarter. And so, you're going to hit an air pocket here a little bit on drawing down of consumer inventories, whatever it may be. Warehouses of TVs are full, I'm sure, in the U.S., trying to get ahead of tariffs, for instance. So there is going to be an air pocket there I think we have to get through on the second quarter. The second is what all this means for consumer and pricing. And I think for Walmart to say that is a bit of a challenge in terms of what is the consumer response to this. And really, the high-end consumer has been carrying consumer spending in the U.S., which, with the market bouncing back to prior highs, in our view, would probably bode reasonably well. And I think one of the big paradoxes in the market is consumer sentiment is terrible, but spending actually remains pretty good. And I think that's evidence of the upper end consumer continues to carry the market. The lower end consumer is struggling, right? Affordability has been challenged. So I think that's something we're really paying attention to in the back half of the year.
You have a couple of stock ideas for us. Steel Dynamics, STLD, you say it's a low-cost producer. What specifically draws you to this name?
Yeah, I think there's a couple structural things here. I gave you, one on Steel Dynamics is, the U.S. is short steel, right? We import steel. I think you got to really pay attention to this administration. One of the things they're very focused on is building in the U.S. They're also focused on maintaining capacity to build things in the U.S. And I think that's a big piece of what they're trying to accomplish. And with that, Steel Dynamics as a low-cost producer in U.S. steel production, in our view, sits really well. They're going to be protected by the administration. Steel prices had already moved up really when some of these tariffs were put into place. So I think that's a net positive. And also with Steel Dynamics, they have a variable cost structure. And what that means is as scrap steel moves up and down, their margins stay relatively constant. And so we're pretty bullish if we think of from a structural perspective or positive, at least on Steel Dynamics here, that the steel industry in the U.S. is going to be well supported. Here's a stock that generates a ton of free cash flow, and they're buying back a lot of stock, and they have a great balance sheet. That fits with our opportunistic sort of value approach to the market here. And I think it's a way to play cyclicality with, some downside protection from the balance sheet and free cash generation.
You have an idea in energy, EQT, a gigantic producer of natural gas. Tell us what draws you here.
Yeah, so we've been relatively bearish crude oil, and I think that's actually played out. And I think we look at the administration, they have talked about their ability to lower inflation was really going to hinge in some ways on the oil markets. And look at the tour that Donald Trump is doing in the Middle East. I think he is working those channels to make sure we're well supplied on oil. That's brought gasoline prices lower. That's brought crude oil prices lower, as we're seeing. But what that, in our view, is positive incrementally for gas for a couple of reasons. One is the U.S. producers of oil are going to start to pare back their activity. That's going to pull down associated gas production in the U.S. We think that's positive. And also, we think the idea and the concept that natural gas is a bridge fuel, it's going to fuel data centers, it's going to go into the LNG market, is alive and well in the U.S. And we structurally think demand is going up in the natural gas market in the U.S. The natural gas producer industry is really consolidated. There's only a few players that are really big, and we think that also bodes well for the supply response. So we think the suppliers are going to be sort of chasing demand here as we get these LNG facilities online on the Gulf Coast. EQT trades at a free cash flow yield that is north of 10%. We think it's quite positive here. They've done some deals to consolidate the industry, but we also think they're going to start buying back stock potentially, and that's also a positive use of cash in our opinion, given where the stock is trading.
It's interesting. I'm not sure. I'm not sure if you saw that story. Sorry. In Texas, they're trying to build out natural gas plants, but they're running out of capacity to get the turbines and to get the equipment and stuff. But I guess that's going to happen if you get any rapid wave of investment in capital equipment.
Yeah, we've been watching the industrial space here, and we were actually talking about this data center build out, the power demand impacts of that. For the market are going to be substantial. And you are seeing that, right? U.S. Electricity demand really had flatlined for a better part of a decade plus due to efficiency. But we think, you're at this inflection point of electricity demand. In big numbers, it's not a huge thing, but to go from flat to up a couple points a year is a big deal for the energy industry or electricity industry. There's a lot of excess capacity out there. So really some of these gas peakers, combined cycle plants, there's room for them to move up their capacity, but that's good for gas demand. But for the data center trade in terms of their ability to supply data centers. Turbines have been a big bottleneck for the industry of varying sizes, right? And you've seen a lot of actually partnerships between the turbine producers and the end market customer. We think that is to lock up that supply. And there is new capacity coming. Some of these turbine manufacturers are building new capacity, but it's with, partnership with some of these end customers that need the power. So that's, we think, a covered capacity increase and much needed in the market.
Thanks very much indeed. Really appreciate it, Aaron.
Thanks, Andy.
Aaron Dunn, Managing Director and Co-Head of Value Equity at Morgan Stanley.